So greetings, everyone. We are already in chapter 3. Now, because I believe chapter 3 is the toughest chapter in this text, or in the understanding, comprehension of financial accounting, we are going to divide this chapter into 2 weeks. For week 1, we're going to cover the first half of it. You will have a review on the first half. You will have homework on this and a quiz on this. But it's just, there's so much material condensed in here. I think it's wise for us to spread it over 2 weeks. So we are going to talk about, we started talking about the accounting cycle in chapter 2. We're going to continue discussing the accounting cycle. And we're talking about the end of the accounting cycle. Now, we know throughout the year, we are aware that we have various transactions or activities throughout the year of a company. And when we have those activities, our job as accountants is to measure and record those transactions. We post all of these transactions, which we call external transactions, because they usually are involved with items for the company that are outside the company, such as purchasing supplies, receiving revenues, recording expenses. And we post them throughout the year. But one thing we're going to talk about today are what we call recording and posting adjusting entries, adjusting journal entries. We need to understand about these adjusting journal entries in order to prepare accurate financial statements. Then we're going to talk about preparing those financial statements next week. And then we're going to talk about closing entries next week. The goal this week is to talk about the adjusting entries that are common for most companies, and then preparing an adjusted trial balance. So before these adjusting entries, we talked in week 2, chapter 2, of preparing a trial balance. And a trial balance is just debits and credits. But this week, we're going to talk about these adjusting entries, and then as a result, an adjusted trial balance. Now, why do we even have these adjusting entries? We have them because we prepare financial statements in accounting according to the accrual basis of accounting instead of the cash basis of accounting. The accrual basis of accounting means that we record revenues and expenses on the income statement at the time the economic activity occurs, not necessarily when cash happens. We record these events when the transactions occur. Sometimes it can include cash, but sometimes it doesn't. Now, one recognition principle in accounting is called the revenue recognition principle. And what this means is that we record revenues in the period in which the goods or the services are provided to the customer. When we did the work, when we completed the job. It doesn't necessarily mean it's when we earn. Again, guys, I told you I don't let anyone in after 8:10, so that's why I'm ignoring that. Sometimes the cash occurs at the same time. but sometimes it doesn't. But accrual basis of accounting means we record revenues in the period in which the goods or services are provided to the customers. The expense recognition, also commonly known as the matching principle, means we report expenses in the same period as the revenues that they helped to generate. The revenue recognition principle states we record revenues in the period in which we provide the goods and services to customers, not necessarily in the period in which we get the cash. Here is a great example. Any of you guys ever been on a cruise? Well, the cruise in this scenario is going to happen in April. In March, the company's purchasing all kinds of supplies for this April cruise. In April, there's cash going out for purchasing fuel. And then in May, they pay all the salaries of those individuals on the cruise ship, working the cruise to help generate those revenues. The revenue for this cruise is going to be recognized in April, even though someone may have paid for this cruise a year before. The revenue the company shows is earned in April. Therefore, we record the revenue in April, and all of the expenses that were generated to help support the revenues earned in April are matched with the revenues earning. So even if supplies were purchased in March for the April cruise, we're going to record those supplies as an expense in April. The cash for the fuel occurred in April. We're going to record it in April because the revenues are recorded in April, because that's when we earned those revenues. That's when it took place. And then in May, even though the salaries weren't paid until May, since those salaries happened in April, that was when the employees did the work. We record those expenses in April to help offset the revenues that they helped incur. Most expenses are recorded in the same period as the revenues they help to generate. Other expenses that are indirectly related to producing revenues get recorded in the period that they occur. So guys, first question: which statement best describes when expenses should be recorded? Expenses are recorded when paid. Expenses are recorded the day a company promises to pay. No. Expenses are recorded when the cost is used to help produce the revenues. Is that correct? Yes. Expenses get recorded in the same period their cost is used to help produce the revenues. That is a really important concept we're talking about this week. There is a cash basis of accounting, and their GAAP, generally accepted accounting principles, use what we call the accrual basis of accounting. The difference, accrual basis happens and when we record it when goods or services are provided to the customers. Under what we call the cash basis of accounting, which is technically not generally accepted accounting principles. So large companies must use the accrual basis of accounting. Under the cash basis of accounting, we record revenues only when the cash is received. Under the accrual basis of accounting, in regards of expenses or the matching principle, we record those costs or period costs. Excuse me, excuse me, one sec. We record the period costs in the period in which they help produce the revenues. Know that under the cash basis of accounting, Jim, will you take this? We record revenues when we receive the cash. We record expenses when the cash is paid. Okay. Generally accepted accounting principles require that we use the cash basis of accounting. Utilizing the cash basis is not part of our GAAP, which we call generally accepted accounting principles. So guys, we're going to look at some various transactions and we're going to talk about when would these get recorded under the accrual basis of accounting and under the cash basis of accounting. So the first transaction, we provide soccer training to customers for cash for $43,000. Now this occurs on December 12th. If on December 12th, we provided soccer training to customers and we received the cash at the same time, under the accrual basis of accounting, what we look at is when did the event occur? When did we earn those revenues? Well, we earned those revenues when the service was provided, which is December 12th. That's when we record the revenues. Under the cash basis of accounting, we say, hey, when did we get the cash? Well, since we also got the cash on December 12th, we're going to record the revenues on the same date because that's when we received the cash. The next transaction says we provide soccer training to customers on account for $20,000. What does that mean? We provided training on December 17th, but we didn't get the cash at that time. So under the accrual basis of accounting, we record revenues when we actually provided the service on December 17th. It doesn't matter we didn't get the cash. We still are going to show the revenue to be recorded when we actually provided the service. Under the cash basis of accounting, are we going to show that revenue on December 17th? No, we're not, because we didn't receive the cash. This slide is all about understanding when we record revenue under the accrual basis of accounting versus under the cash basis of accounting. And we know that the accrual basis of accounting is how we primarily record accounting transactions and prepare financial statements. But this is helping you to understand the difference, okay? Last, on December 23rd, we received cash in advance for soccer training sessions to be given in the future for $6,000. Would we, under the accrual basis of accounting, show any revenue that day? No, we wouldn't, because we didn't do anything. But under the cash basis of accounting, guys, we would show we earned that revenue, or the revenue gets recorded, I should say, because cash was received. Now, on December 1st, we pay 1 year of rent in advance, $60,000, $5,000 per month for a year. Under the accrual basis of accounting, we only record expenses when they are utilized to help earn those revenues. In this case, the cost has not been incurred yet. We paid the money up front for rent for an entire year. But we don't record that as an expense under the accrual basis of accounting until the rent expires. Under the cash basis of accounting, we would show that entire $60,000 as an expense when we paid it. On December 6th, we purchased supplies on account. Well, when we purchase supplies, that is an asset, but we don't treat it as a cost or as an expense until they are used. So on December 6th, we would not show that as an expense. And under the cash basis of accounting, we also wouldn't show that as an expense because we did not use cash to pay for them. And then last, on December 28th, we pay salaries to employees for $28,000. Well, in this case, under the accrual basis of accounting, we would show that as an expense because the cost was used in December. Therefore, that's why we would show that as a cost and expense. And under the accrual basis of accounting, we would also show this as an expense because we paid for it. Remember, the difference between the accrual basis of accounting and the cash basis of accounting is only timing. Under the accrual basis of accounting, we record revenues when we provide the goods and services to the customers. And we record expenses with the revenues they help to generate. Under the cash basis of accounting, we record revenues when we receive cash, and we record expenses when we pay cash. Cash basis of accounting is not allowed for financial reporting purposes for most companies. So guys, I'm going to have you look at this for a moment, and I want someone to help answer this. Okay? Anyone willing to try to attempt this? Okay, if no one is attempting it, you know who I'm going to call on? Guess who? Anne, can you attempt it?
Yep. I think, well, I don't know. See, a lot of them really, you could, um, you could, um, on the accrual basis accounting could be, put that way. But I think that maybe it's B.
It is B. Here's why. The question says, which of the following would be recorded as an expense? So C wouldn't be because they're providing services, which would be revenue. You see what I'm saying? Services, providing services to customers would be revenue. Here. Hey, Wyatt, are you there? Wyatt, are you there? Wyatt, can you unmute your recording? Wyatt? The reason I don't invite you in is because you're way late. You have to be in by 8:10 in the morning for me to admit you. I'm not trying to be rude, but I'm just telling you that's why I don't invite you in. I think this happened last week too. So you need to be in here at by 8:10 in the morning. Okay. Sorry, guys. I don't mean to be rude about it. I just want people to come when the class begins. Okay. So that's why C is wrong, Anne, because the question is, when do you record an expense? Well, C is revenue, so that's why C is wrong. The company purchases equipment by borrowing from a bank. Equipment is an asset. So yes, we would record that equipment when they purchased it, but that's not an expense either. So you are correct. B is the right answer, because B is when a utility is an expense and it gets recorded when the service or the cost occurred, even though the cash isn't paid. The reason A isn't right is because office supplies will be treated as an asset until they use them. C isn't right because providing services to customers is a revenue, not an expense. And then the company purchases equipment by borrowing from the bank. Equipment is an asset, not an expense. Do you guys understand that? Does that make sense? An accrual basis expense is recorded when a cost is used to help produce revenue. A company that utilizes or uses utilities has incurred a cost that helped to produce revenues in the current period, and therefore we would record that as a utilities expense. Now, how about this one? Which of the following would be recorded as an expense under the cash basis of accounting? A. Because under cash basis is you record an expense when you pay the cash, not necessarily when it's being used. Okay. Now let's look at this exercise. We're going to look at these various transactions and determine when the company would recognize the revenue under the accrual basis of accounting. So number one, American Airlines collects cash on June 12th from the sale of a ticket to a customer, but the flight doesn't happen until August 16th. So when will American Airlines recognize that revenue? When the actual revenue occurs on August 16th. They recognize it when the service has been or is provided. On this one, a customer purchases sunglasses from Eddie Bauer on January 27th on account. Eddie Bauer receives the payment from the customer on February 2nd. But when did the transaction actually take place? When did the customer get those sunglasses? On January 27th, that's when the revenue would be shown. On March 30th, a customer pre-orders 10 Supreme pizzas from Pizza Hut for a birthday party. The pizzas are prepared and delivered on April 2nd. The company receives cash at the time of delivery. When would we record this? On April 2nd. When did the actual goods take place, get transferred to the customer? April 2nd. This one's trickier. A customer pays in advance for a 3-month subscription to Sports Illustrated on July 1st. Issues are scheduled for delivery each week from July 1st through September 30th. So even though the customer pays all of it on July 1st, when does the service or the goods, when are they actually provided? Every week. So the revenue is going to be recognized as each magazine is delivered. So if it's a 3-month subscription and there's 4 weeks in a month, there's 12 magazines going out. So 1/12 of the subscription would be recognized as revenue each week. Okay? Okay, somehow that's in there twice. Now, we're going to talk about the measurement transaction, this adjusting entries. There are going to be 4 types of adjusting entries we are going to need to make for our books. So prepayments and a related adjusting entries mean sometimes we pay up front for a cost, such as prepaid rent, prepaid insurance. And when the cash is paid, we create an asset. But as the cost gets used, like rent at the end of each month, we need to show it as an expense, take it out of the asset and show it as an expense each month. Note, or at the end of the year, but note that the adjusting entry we need to be aware of is we need to reduce the asset, the prepaid insurance or prepaid rent, prepaid advertising, reduce that asset and recognize the expense when it has expired. The deferred revenue is when we receive cash in advance for services we need to provide. The adjusting entry we need to be aware of is when the services are provided, we need to reduce that liability, usually deferred revenue, and show that we really did earn that revenue. We recognize the revenue at that time and we reduce our liability. 2 others relate to accruals and related adjusting entries. An accrued expense is when a cost has been used up, but we haven't paid the bill yet. So an accrued expense is when we have utilized some utilities. So the cost was used, but we haven't paid a bill or even received a bill. In that case, we recognize the expense and show a liability for the amount we need to pay. And then in a future period, we'll pay the liability. For an accrued revenue, there are services that we have provided, but we haven't necessarily sent out an invoice. So in the current period, we would recognize that revenue for the services we've provided. We'd also show an asset, accounts receivable. And in the future period is when the cash will come in. The reason we do this is to accurately record revenues in the period in which they were earned and costs in the period that they helped to produce those revenues. So we're going to look at these various transactions and notice that some of these transactions have occurred during the period but have not been recorded by the end of the period. And usually this involves using up supplies, earning interest, and rent expiring. So we're going to talk about repaid expenses, deferred revenues, and then accruals would be accrued expenses and accrued revenues. Again, prepaid expenses mean it's the cost of assets that were acquired in one period, but they'll be recorded as an expense in a future period. Initially, we recorded that as an asset because they provided us with a future benefit, such as paying rent in one year at a time. We're paying 12 months worth of rent up front, but the rent doesn't actually come due until the end of each month, or excuse me, it expires. So we expense these costs in future periods as the asset gets used up. In this case, what we'll do as our adjusting entry is we debit the expense account and we credit an asset account. Okay, so on December 1st, we purchased 1 year of rent in advance for $60,000, which was $5,000 per month. On December 31st, 1 month of rent has already expired. So we know that we need to show the adjusting entry for that 1 month of rent that has expired to be a debit to rent expense for $5,000. And we will credit our prepaid rent for $5,000 since we've used up $5,000 of that asset. Okay. Now, on December 6th, we purchased supplies for $23,000 on account on December 6th. So at that time, we debited supplies and we credited accounts payable. At the end of December, account of supplies shows that we only have 13,000 of them remaining. So we need to show an adjusting entry to show supplies of 10,000 have been used up, which means we would debit our supplies expense for 10,000 and we would credit our asset supplies for 10,000. Initially, when we received those supplies, we showed it as an asset. Now that 10,000 of the supplies have been used up, we need to show that as an expense. Excuse me 1 second here. Okay. Next. On December 1st, we purchased equipment for 120,000 cash. So this is a new concept we'll talk about called depreciation. When we purchase an asset, it's clearly an asset. The equipment is an asset, a building is an asset. But that asset does get used up. It does get, there is a cost associated with using that asset that we call depreciation. So there are different methods of determining how much of that asset is being used. In this case, when an asset gets used, we come up with a method to determine how long that asset can be successfully benefit a company. But each month we show depreciation expense as the portion of that asset getting used up. In this case, we purchased equipment on December 1st for 120,000. At the end of the month, we're showing that $2,000 of that equipment got used up. So we're going to show a depreciation expense as a cost of using this asset. And the corresponding credit to this journal entry is called accumulated depreciation. We're going to learn more about this, but accumulated depreciation is called a contra account. Instead of crediting equipment, we credit accumulated depreciation. So we clearly keep intact the original cost of that equipment. And accumulated depreciation helps us see how much of that equipment we have already used up or shown on our books as an expense. How's everyone doing so far? Are you hanging in there? This question, Golden Eagle Company prepares monthly financial statements for the bank. The November and December 31st adjusted trial balances include the following account information. So we see at the end of November, we showed supplies of 2,000 as a debit. And then on December 31st, we show supplies as a debit of 3,500. It gives us some additional information. It says purchases of supplies in December totaled $4,500. So what they want us to do is be able to determine what journal entry, adjusting journal entry, was made in regards to supplies. So if you think about it, if supplies began in November at 2,000, we know $4,500 of supplies was added in December. That would have made the balance in supplies to be 6,500. But if we see at the end of December, there's 3,500 shown in supplies, wouldn't that mean, we prepared a journal entry of supplies expense of $3,000, and we credited supplies of $3,000 because $3,000 of supplies were used up during the month. So the way that we determine in this scenario the supplies that were used up is we start with the beginning of the month's balance. We add any purchases during the month. And if we see the ending balance was 3,500, we know we used up $3,000 of supplies during the period, which the journal entry would be a debit to supplies expense and a credit to the asset supplies. Look at prepaid insurance. It started the month with 8,000. It tells us that no insurance payments were made in December. And we see the balance at the end of December of 6,000, which means we utilized $2,000 of insurance. Therefore, the adjusting journal entry would be insurance expense of $2,000, and we'd credit our prepaid insurance of $2,000. Next, salaries payable at the end of November is 11,000. This is a liability. It says 11,000 is paid to employees during December for November salaries. So what that means to me is at the end of November, they created an adjusting journal entry of 11,000. And that salary that was occurred in November was paid in December. So that wiped out the $11,000 accounts payable. But if we now show a December 31st balance of 16,000 as a salaries payable, we know we would debit salaries expense for 16,000 and we would credit salaries payable for 16,000. This adjusting journal entry shows the salaries that were incurred in December, even though they're not going to get paid until January. Lastly, deferred revenue had a November 30th balance of 3,000. We also see a note on November 1st. So this is before this November 30th balance of 3,000. On November 1st, a tenant pays Golden Eagle $4,500 in advance rent for the period November through January. And at that time, deferred revenue is credited. So if you think about it, Golden Eagle received on November 1st 3 months of rent in advance, $1,500 a month, 3 months in advance. And at that time, when Golden Eagle received that $4,500, they debited cash and they credited deferred revenue, a liability account. Each month, as they were able to provide that rent to the client, they reduced the liability deferred revenue, and they showed as rent revenue $1,500. So that must have been what they did at the end of November. Now at the end of December, another $1,500 was earned in rent revenue. Therefore, we know the adjusting entry would have been a debit or reducing the liability deferred revenue and crediting rent revenue because now they earned, just through the passage of time, they earned revenue for the period. Okay, service revenue. This is an example, guys, of various adjusting journal entries that need to be provided at the end of the period so we can give accurate financial statements. Okay, guys, I want someone else to answer this besides Ann. Which of the following is recorded with an adjusting entry associated with a prepaid expense? Anyone? So this is an example of prepaid rent, prepaid insurance, prepaid advertising. It was paid up front, but then as it gets used up, don't we credit an asset? We credit that prepaid expense to reduce it, and we debit that expense. The adjusting entry involving a prepaid expense always involves a debit to an expense and a credit to an asset. So we kind of touched on depreciation in one of those examples. Let's talk about depreciation. So you see here in the balance sheet of Federal Express, various assets on their books. Okay, 65 mil, well, this is shown in millions, but let's just keep it simple, 65,024. That was the cost of their assets when they were purchased. The depreciation that has been taken on those assets so far over the lifetime of those assets is under the less accumulated depreciation section, the 31,416. So although they purchased this 65,024 in assets, 31,416 of those assets have been expensed to depreciation expense, because the offsetting journal entry, when we record a depreciation expense in a period, we credit accumulated depreciation. Therefore, you see on this slide a net property and equipment that they show on their books is 33,608. The difference between what they purchased those assets for minus the depreciation that has already been taken on those assets. So guys, which of the following is equivalent to the book value of an asset? It's going to be the cost of the asset less the accumulated depreciation. Okay. Now, we know deferred revenues arise when a company receives cash in advance from customers, but the product or the services don't get provided until a later period. So when a company receives cash before providing services to customers, it owes the customer a service in return, which creates that liability. But then, when those services get provided, the liability is no longer, it gets reduced. And an adjusting entry is needed to decrease the liability to what we still owe and then show the revenue. So on December 23rd, a company received $6,000 in advance from a customer. So at that time, we debit our cash and we credit our deferred revenue. But within 7 to 8 days, we've provided $2,000 in revenues, or services, I should say, we provided. So $2,000 has been earned. the adjusting entry to show that those $2,000 have been earned would be to debit our deferred revenue of 2,000 and to then credit service revenue to show revenues of $2,000. So let's look at some more examples. Again, this continually to process these is really how you learn how to do it. I want you to look at these, and I want you guys to take a couple minutes to attempt these. Now, I want you guys, there's a couple of y'all in here. It'd be great, even if you're learning, guys, this is how we learn. But I want to make sure you're in here and you're really trying. So, Abby, Anna, Araceli, Vi, Joe, Jackie, you guys know who you are. I'm not going to force you guys, but try. Please attempt one of these. So I'm going to mute 2 minutes and I'll be back on, and I'm going to ask someone to kind of help me walk through these. Okay. That's how we learn. 2 minutes. Hi, guys. How you doing? Am I being pushy to ask anyone to try to take part A?
I can do it.
Thank you.
All right, so 4,500 evenly over 3 months would be 15 each month.
Mhm.
So you would have deferred and then you would have the service revenue, deferred revenue and service revenue.
Absolutely. That is awesome. You're exactly right. So you would debit deferred revenue of 1,500 and you would credit that service revenue of 1,500 at the end of each month. Awesome. Thank you so much. Who wants to take B? Anyone? This is a tricky one, guys. I'll do it because I don't want to freak y'all out. So on December 1st, a company pays $2,700 for 30 radio ads to be aired $10 per month through December, January, and February. Or excuse me, 10 per month. So 10 ads a month. At that time, they debited prepaid advertising for $2,700 and credited cash. At the end of December, if 900, excuse me, $900 worth of radio ads were used up, wouldn't we debit advertising expense? A third of that was used up, and we credit prepaid advertising because we no longer have that entire asset. We've used up $900 of it. And that would happen every month, December, January, and February. Make sense? Who wants to take C? Anyone? Anybody? Okay, think of this, guys. In December, employees worked, but they're not getting paid until January 7th. But don't we need to show on our books that we did have a cost of salaries expense at the end of the month, even though we're not paying them till January? When did they actually work? They worked in December. Therefore, we need to show a debit to salaries expense of 8,000, and we credit salaries payable of 8,000. The last one says on August 31st, Shocker borrows 70,000 from a local bank. A note is signed with principal and 9% interest to be paid on August 31st, 2019. So what happens is when you borrow money from a bank, that money has a cost. It's called interest. And so since we haven't even had to pay the bank anything, actually, my dates are goofy here. This should be August 1st, 2023. So what's going to happen is on August 31st, 2022, we borrowed money, but we're not paying it. And we're going to pay it all off, including interest, in 2023. Okay. So in 2023, we pay it off. But as of December 31st of 2022, we've incurred interest expense. We just haven't paid it yet. So if we take our 70,000 times 9% annual interest rate, that would be 6,300. We figure out how many months 6,300 would be for a 12-month period. But how many months has this loan been going for, and what do we owe in interest expense? What's been incurred at the end of the year? September, October, November, and December. So we have incurred 4 months of interest. 4 months of interest with 6,300 being what will happen over 12 months. A third of that is 2,100. So we need to show a journal entry of interest expense 2,100, and we call it interest payable of 2,100. That interest won't get paid until August of 2023, but we've incurred it and we owe it. Okay. Remember, accrued expenses are recorded when a company has a cost that is used to help produce revenue, but hasn't yet paid cash for that cost. The cost gets recorded as an expense, and the amount owed is recorded as a liability. So we debit the expense account and we credit the liability account, just like we did here. What about this? By December 31st, 3,000 in salaries have been incurred or earned by employees or incurred by the company for the final 3 days of the month. These salaries are not paid by December 31st. So you see, we have to show that $3,000 of an expense, and we show it because they're not going to receive that money until January. Therefore, the adjusting entry for the end of the year is salaries expense of 3,000 and salaries payable is a credit of 3,000. So guys, if a company pays an employee $100 per day for a 5-day work week that runs from Monday to Friday, and December 31st is a Tuesday, what is the amount of the salaries adjustment, assuming that Friday is the payday? Well, wouldn't we want to record salaries expense of $200, salaries payable of $200, because since December 31st ends the year, we need to correctly show that expense in the year in which it was incurred. By December 31st, utility costs of $9,000 have been incurred but have not yet been paid. So even though we pay those utilities in January, they happened in December. So we need to debit our utilities expense in the period in which they happened, that we incurred them, even though we're not going to pay them till the next year. And do you see here we debit our utilities payable of 9,000? On December 31st, 1 month of interest has been charged for borrowing 100,000 at a 12% interest rate. Guys, many people think that 12% interest rate is monthly. No, we always show interest, the rate of interest percent on an annual basis. So really, if 12% is annual, then 1% is monthly. So we need to show that $1,000 of interest was incurred by December 31st. So we would show interest expense of 1,000, and we would credit our interest payable of 1,000 for this year ending December 31st. A year later, when we finally pay back what we borrowed along with the interest, in the next year, we would show an interest expense of 11,000, because in this previous year, we're showing this 1,000 of interest expense that incurred in this period. Okay. When recording the interest payable on a borrowed amount, students sometimes mistakenly credit the liability associated with the principal amount, the notes payable, but we don't do that. We record interest payable in a separate account because we want to keep track of how much we are paying down the note, the amount we borrowed, versus how much we owe due to interest. Keep them separate, guys. Okay, I want you guys to attempt this. And I want each person to put their answer in the chat box. So I want everyone to contribute here. Okay, I'll give you a couple minutes. Okay, we need more people. Everyone needs to put their answer in. Great. Let's see. 200. Looks like you guys all got the same answer. So 20,000 a company borrowed, and we have 2 months we need to show the interest expense. 20,000 times 6% times 2 months out of 12 months. Awesome, guys. Interest expense is 200. Interest payable is 200. And then accrued revenues, when a company provides products or services to customers but hasn't yet received cash, it records the revenue and it also records an asset for the amount expected to receive. So we would debit our accounts receivable and we would credit our revenue account. Okay, even though we're not going to receive the money until the next year, we still want to show we earned that money in this period. So an adjusting entry will be needed for accrued salaries and adjusting entries needed for services provided but haven't been billed, and for interest accrued on a loan payable. Unnecessary adjusting entries are transactions that do not involve the recognition of revenues and expenses. Borrowing, repaying debt, issuing common stock, and paying dividends, there's nothing you're going to need to do there. Transactions in which we receive cash at the same time we record revenues or pay cash, we record an expense. You don't need to do anything about that because it will take care of itself. After we prepare all of these adjusting entries, we will then create an adjusted trial balance. That includes all of these adjusting entries we have taken into account. It's going to be, guys, this adjusted trial balance we will use to prepare our financial statements that we're going to talk about next week. But this is utilized, or what we create after we've taken into account and prepared all of our adjusting entries. We're not going to talk about this portion now. We're going to talk about financial statements next week. This is as far as we're going to go this week because there's a lot here to cover. Okay? Does anyone have any questions at all? How are you doing?
Doing good.
Good. Let's look at something here. Your review will be due on Thursday, right? Tomorrow.
Yep.
The homework will be due Monday and the quiz will be due Monday. Let's look at number 3 here. The information necessary for preparing the 2024 year-end adjusting entries for Bearcat Personal Training Academy appears below. We are going to just take some time, guys, and record these journal entries. Number 1 says, at the end of the year, Bearcat calculated that it owed $24,000 in income taxes, but those taxes aren't going to be paid until April 15th of the next year. So what do you guys think would be one account that would be affected in owing $24,000 of income taxes? Anyone?
Is it accounts payable?
One could be accounts payable or income taxes payable, but we know one is income tax expense, right? Because it's telling us we owe 24,000 for this year in income taxes. So we know income tax expense. But if we scroll here and see that they show us income tax payable, we're going to use that one because it's very specific to this. Accounts payable is used more for paying bills. But again, let's say we're paying a utility bill. And if we can see in the drop down box, it shows utilities payable, we'll take that one. But let's try account income tax payable, 24,000. Guys, we can go over here and check your work. And we have it right. Okay, so if there is an answer that says income tax payable, you can try it and see where it gets you there. Okay. Now, I want to view journal entry worksheet. Let's go to the worksheet. So if I saw there was an accounts payable, I can try it. I can check my work. Nope, wrong. So we know we've got to come up with a better scenario there. Okay. Number 2, salaries owed, but not paid to employees for work from December 16th through December 31st, 2024 are $4,000. Record the adjusting entry for salaries at its year end. We know we're going to debit an expense and we're going to credit a payable. Is there a well, and we know it's salaries, so we need to go and look at salaries expense. There we got it. 4,000. And then salaries payable is 4,000. If you're not sure if it's right, check your work. Oh my goodness, I thought I fixed that accounts payable. I'll go in here, income tax payable. Okay. What about this one? Bearcat lent an employee 20,000. The employee signed a note requiring principal and interest at 9% to be paid on February 28th, 2025. So it lent the money March 1st. The employer lent the money March 1st, but the employee isn't going to pay it back until February 28th of 25, a year later. We need to record the interest the employee is going to owe Bearcat from March 1st until the end of the year. The first thing to question is, how many months is this? And triple check your work, guys. March 1st through December 31st is 10 months. 10 months. So how are we going to calculate this interest? 20,000 times 9% is $1,800 for a whole year. What is 10 months of $1,800? You know, if 1,800 isn't for 12 months, what would be for 10 months? Anyone?
1,500.
Excellent. So this is where we will say interest expense of 1,500. and interest payable of 1,500. Okay, look, guys, what happens on this one. If I check my work, it's gonna say it's wrong. It is right, though. Remember, this is that one. It's screwed up. It is correct. So just ignore it. It is correct. Okay? It's just a glitch in the software. So guys, we're going to go through all of these. Excuse me, I'm wrong one. Whoops. On April 1st, 2024, Bearcat paid an insurance company $13,200 for a 2-year fire insurance policy. The entire $13,200 was debited to prepaid insurance on April 1st, which was the correct thing to do. But now on December 31st, we need to show how much of that fire insurance has expired, meaning it's now an expense. Okay, so if $6,600 is 1 year, 13,200 is for a 2-year policy, which means 6,600 of it is for 1 year, for 12 months. And if we've already gone through 9 of those 12 months, see what I'm trying to get at? Then what do we need to show was expired? So we need to basically take 3/4 of the 75% of the 6,600 has been expired. How much would that be, guys? Somebody. Don't make Ann do all the work.
Is it 49.50?
I'm sorry, how much?
49.50?
Thank you. 49.50. Guys, is this making sense? Are you getting it? Oh, I should have said insurance payable. Oh my goodness gracious. This should be insurance payable. Oh, shoot, not insurance payable, prepaid insurance. God, I thought I did that. There it goes. Remember, this problem 3, that is an error here. But you know what? It shouldn't be accounts receivable. It should be interest payable. What am I doing? Oh, my Lord. Interest expense, interest payable. That is correct. But where it's goofy is that they show that number to be wrong. Just trust me, it is right there. Okay. Okay, number 5. Bearcat used $1,700 of supplies in 2024. The supplies account was debited at the time of purchases, record the adjusting entry for supplies at year end. If we used up $1,700 of supplies, we know we need to show an supplies expense of 1,700. And we would credit the account supplies of 1,700. You can always check your work except for number 3. Okay. Now for number 6. If Bearcat received 2,700 from a customer on October 31st for 3 months of personal training that began on November 24th, Bearcat credited deferred revenue on October 31st at the time of receipt, but has done nothing since. So at the end of the year, if 2,700 was for 3 months of personal training, 2 of those months have been used up. So wouldn't we want to take 2 months or $1,800 and debit the deferred revenue because it is no longer a liability? We have earned it. And we would call service revenue of 1,800 because we've earned $1,800 of this money. Correct? Make sense? So in this scenario, Bearcat had paid a bunch of rent up front. $500 a month or $6,000 a year for an annual. And it was paid on December 1st. Now it is December 31st. So 1 month has been used up. What would be the journal entry to adjust, record an adjusting entry for using up rent? We'll always debit a rent expense for $500, and we credit our prepaid rent for $500. No, whenever we're dealing with prepaids, the adjustment will be a debit to an expense and a credit to the prepaid to reduce that asset. Because that rent or that insurance or that advertising has expired. So there you go, guys. Know that please use the discussion board to ask questions. Please use Stuart. He's an amazing accounting tutor, guys. I just can't say enough about Stuart. And he's in here checking the discussions also. So utilize him. He's great. He knows what he's doing. Get the help you need. We're here for you. Also, guys, don't wait until Monday night to submit your assignments and turn in your homework. It's inevitable there's problems at the last minute. So I give you all week. I know it's hard to do things during the week. If you're a procrastinator, you wait till the end, but it can kind of get you in some trouble too. Are you guys doing okay? Do you have any questions before I end this? Well, guys, feel free to email me. I'm here to help you. And I will see you for sure next week at this time. Okay, take
Sounds
care,
good.
guys.
Bye.
Bye-bye.
Bye.
Bye.